morning, everyone. My name is Yaron Naymark. I'm the founder and CIO of One Main Capital. As a shareholder of Limbach, I'm excited to introduce you guys to Mike McCann today, who's the company's CEO. Limbach, just to give you guys a little quick background on the company, and then I'll let him do the longer one, is a specialty contractor that focuses on mechanical and electrical building control systems, primarily HVAC, in mission-critical infrastructure assets that are not economically sensitive. So you could think hospitals, data centers, higher ed, biotech-type facilities that need them up and running and tend to be less price-sensitive to making sure they have the equipment working in the right way at the right time. And the company's undergone a two-step transformation. I think they're halfway in the middle of what is a beautiful transformation. Step one was fixing the balance sheet, fixing the income statement, and fixing leadership. And in terms of the balance sheet, they used to have a net debt balance sheet, and now they're a net cash. In terms of the income statement, they used to be a very low margin, low return on capital, highly volatile business. And they've stopped doing a lot of the major projects that have led to cost overruns and losses, and have improved margins. And in terms of leadership, we have Mike here who's gonna talk to you all. I think, like I said, I think we're halfway through. Step two, involves continuing to shift the business away from general contractors and these big volatile projects towards doing work directly for owners, which tends to be higher margin, lower volatility, lower ticket sizes, less capital, working capital intensive. And I think margins should continue to shift up nicely over time, and Mike will talk to you guys about that. And then the other part of step two of the transformation is the M&A opportunity that's out there. The company today trades at 8 times EBITDA, 10 times free cash flow, but they could deploy all the free cash flow they generate at about 4 times EBITDA into acquisitions that increase the scale of the company, improve the geographic diversification of the company. And when you could deploy free cash flow at 4 times EBITDA, it helps you grow free cash flow per share nicely over time. And I absolutely think Mike is the right guy to lead the company into this transformation. He joined the company in 2010. Whenever I speak to him, he's totally in the weeds. He's obsessed with customers. He's obsessed with the product. And I think he worked his way up to COO and got promoted to CEO earlier this year. And so, I'll let him take it from here and give you guys a broader intro, but I absolutely think he's the right guy to lead the ship.
Oh, again, I've been with the company since 2010. I've worked my way up, and earlier this year we had a transition from the previous CEO, Charlie Bacon. So the company's been around since 1901. It was a family-owned business for 80 or 90 years. We were actually owned by Enron for a period of time, picked up private equity, and we went public in 2016 through a SPAC. And I'll get you a little bit more into detail about our transformation as a company. But as just was mentioned, Limbach's a building solutions systems firm. And I think I've been very particular about the definition of this, because I think we were perceived, and we were much more of a construction company 3, 4, 5, 6 years ago, and really in our complete past history. And we're much more, at this point, focused on existing buildings and the full life cycle of those existing buildings. We want to focus on a core group of customers, embed ourselves in there, understand their business, learn from them, and present back solutions. So who we are at a glance. Our purpose is to maintain and optimize mission-critical systems. And we have our 6 vertical markets on the right side in the green pie. And what we've done over the last 4 or 5 years, and even specifically more this year, is we try to cull down our customer list and make sure our customer list is really laser focused on these 6 vertical markets. What makes these 6 vertical markets unique is they have to make the repair. So I'll just use an example of this. If you're at a K through 12 school, it's not operating in the summer. Sometimes they'll wait from Friday to Monday to make that call. If we're working in a healthcare facility and we're working specific on the OR, they're going to want to make those repairs instantly. And that's the mission critical nature of the business that we want. The second piece of this too is our goal is to be an indispensable partner to these customers. And that takes time. We're way far back in our journey to get to that point. We want to embed, become a partner, and get to the point where they have to have us. They need us to operate their building. As an example of this, and we have a long way to go as a company, is there's a health group in the Ohio region that has 8 or 9 hospitals. Hospitals right now are having a tough time from deferred maintenance to finding staff. Over the last 3 or 4 years, we've gotten, and even recently, we got to the point where they needed staff augmentation, and we basically become their staff at the hospital. That's how the part is we start to really embed ourselves. And that's just one example of relationships that we're pursuing, or we're in some stage, most likely in an early stage. The other thing I want to focus right here too on our uniques is what makes us unique in our space is the focus and discipline. We've learned over the years, and myself specific, again, I've been with the company for 15 years, so I've seen a lot. Discipline is extremely important. It's a detailed business. You got to know your customers. And I think the other thing too is, we're a $500 million company, and in our space, we're still a smaller company, and we want to make sure we understand the details so we're flexible and nimble to be able to move. And then the other side of it is obviously our offerings. 3 basic core offerings that we have. Maintenance agreements, we have on-demand time and material work, and we have project work. That could be super small project work to larger scale capital projects. One thing we've done to de-risk the business over the last 3 or 4 years is we've cut down on these large projects. So you've seen arena going on outside. Most likely that's going to have claims. Most likely people aren't going to get paid. And those are the projects in our space that a lot of our competitors take. We're much more focused on letting somebody else build it and then coming back and maintaining it and working on infrastructure energy upgrades. That's kind of the style of business that we've modified to. So we have 2 segments. And there's a lot of acronyms in our company, just like a lot of companies, but just to kind of go through these, and you'll hear these or read about these. There's the GCR segment, General Contractor Relationship, and the simplest way I can describe this is a 2-step. We work for the GC who works for the owner. And most of the time in this space, we're already responding to a solution that's been built by somebody else. And that's what drives the margins down to the 12 to 15% range. In our business in the past, was basically 85% on this side of the business. And you can see from the margin profile. The second segment is the owner direct relationship. So we're working directly for the owner, 1-step model, and we're listening to the customer, we're embedded, and we're proposing solutions. So I was on a call yesterday and somebody was asking about bidding. I'm like, we don't bid. That's just like a 4-letter word in our world. We propose a solution. And a lot of times when we propose a solution, we're not competitive, like somebody's making 15%, 20, 25. We're responding to the operating costs of the building. And that's where we're almost in a chase of capital with that customer. And that's what drives the higher margins. And so the business is really shifting from GCR to owner direct relationships. The other thing too, one more thing to add here too is GCR tends to be a lot of new construction, owner direct tends to be existing building. So just a couple things on this slide. I won't get into too much details, but the balance sheet, obviously we ended Q2 with $46 million in cash, and we have about $40 million on a revolver. We only have $10 million borrowed, and that's because we've hedged that. I think it's 5.27% approximately. So what's happening is we switched our business, and the business has started to generate cash. And our goal is to use that cash to invest. The other thing too to point out from a customer spend perspective is our customers a lot of times will flex between OpEx spend and CapEx spend. OpEx spend is the on-demand stuff. CapEx is the longer term spend plans, and that could be capital projects. So one good thing with our strategy going forward is we're able to flex, and we're able to flex with different customers from their spend profile. So I get a lot of questions about comfort in MCOR, because a lot of times we get compared to that, and I'll go into that a little bit, but we have a very different model. So I'd say when we went public, it was much more of a comfort in MCOR, a roll-up based on larger construction. There was some basic service work. Just an example of what's differentiator for us from those companies. And those are great companies, by the way, but we have a different model. We look at the traditional service models. You sell a maintenance contract, and then you get pull-through work out of it. A lot of times you'll build a job, sell the maintenance, and get pull-through. We have the reverse model of that, and it's a lot less dependent on the maintenance agreement. We look at the lifetime value of the customer, how much we spend, and the opportunity. And that could come from our three different services, maintenance, T&M, or projects. But we're much more focused on the customer relationship, and we don't want to build that big risky job to get the maintenance. I want to get in there first, start slowly, build confidence and build trust, and work our way up through the relationship. So we're very focused on that trusted partnership and committing people to certain owners as opposed to spreading a broad stroke. So this is a chart of kind of who we get comp to sometimes, and also from a competitor perspective. So 3 things that separates us from a customer perspective is, and they only really work well together. Disciplined approach, we have engineers in-house providing solutions, and we have the craft expertise. So if you look at these different competitors, each one of them has a piece of this, but ours is kind of a unique one-stop shop for that from these different competitors. And we look at it this way, and I've got a kind of a chart that kind of goes through these. From a valuation perspective, from who we compete against, a lot of people compare us to those Comfort and MCOR. Just an example, MCOR does 11 or 12 billion. We couldn't be anything further from that, but people look at us from the E&C space and think, okay, that's who you want to be. And their margins kind of reflect that. So our margins last quarter was about 22, 23%. These companies run in the 15 to 17 to 18% gross margin perspective. So our goal is to move to the far right, where we're an engineering solutions company with craft expertise, and that's where I think further down the line it's much more, the comps will be much more relative to the OEM firms, Aon, Trane, Siemens, Johnson. Some of those are bigger companies, but their margins are in the 30s. And over time, our goal is to shift from traditional construction companies to solutions companies over a period of time. And if I was to chart us, I'd chart us down here, like below this slide deck, to I think where we're at from a value perspective, and obviously where we're at in our journey. We got a long way to go in our journey. So I talked a little bit about mission critical markets. Our goal is to be resilient with these customers. So right now, a lot of the construction space, there's tons of work going on right now. It's very easy. It would have been very easy for us to build a gigantic backlog right now. In our model, in some senses, we're preparing for the long term. Our backlog could be double what it was, but we're super disciplined on getting 10, 20, 30-year customers working in existing buildings, because their construction can get very cyclical. It could be on the rise, and all of a sudden it's going to drop off. There'll be some index that comes out that drops it off. We're building for the long term. We want to be in the facilities, and when people go through these cycles, sometimes they'll be in a position where they need the work and they'll come back to the facility. We're already going to be in the facility. We'll know the facility, and we'll have staff augmented their facility. So our goal is much more about durable demand over a long term, focus on these mission critical customers. So I always talk about this. I'm the type of person, I need a simple strategy. And we've had a lot of change in our company. And people ask me, what's the most difficult part? The most difficult part is internal change management. And we've really, since I became CEO, I'm laser focused on simple strategy. And it's a 3-piece. Shift from GCR to owner direct. Increase our offerings for margin expansion and scale through acquisition. So I'll talk about the first pillar. Our goal a couple years ago was to be 50-50 mix by 2025. We revised that to be 50-50 mix in 2023, and we've kind of set out a new goal being 70-30. And this is going to continue to shift. And you think about it from a very simple perspective. ODR, owner direct relationships, is 25 to 28. GCR is 12 to 15. We're going to get a pickup just as we shift from one segment to the next, staying in those margin segments. The other piece of it is, okay, we're going to get a pickup from the mix, but we can also get a pickup from evolving our offerings. So how can we take 25 to 28 and move that to 28 to 32 over a long period of time? And our goal is to change that by betting on these customers, spending time with them, and starting to allow them to allow us to plan their budget over a long period of time, and then we can add offerings that allows us to expand those margins. And the last piece of it is scaling through acquisitions. Our goal is the base business produces cash that allows us to do acquisitions. And we've done a couple acquisitions in the last 18 months, and I'll get into those a little bit further. But very simple. 3-part strategy that kind of works in concert together and has beneficial pickup in each one of the pillars. I mentioned this before. I'm not going to get into too much of this. But again, the company in 2017 when we went public was 20% construction. At this point, we flipped the model completely to the point where we want to be as far owner direct as possible. And again, as I mentioned, evolve offerings. We want to make sure that we have the quick hitting work, which is the OpEx work, and we're working on the longer term planning. We want to be in position with our customers, and one thing we tell our locations, and we have 12 locations, we have about 14 to 1,500 employees. We tell these locations, we want you to spend 80% of your time on your top 5 customers and allow yourself to be embedded into those customers, be a part of their business, and be able to capitalize on whatever spend that they have and work their plans. So just as a quick graph to kind of show what's happened as we've shifted the segment. It's pretty obvious as the mix has turned closer to 50%, our gross margin's gone up and our adjusted margin. So pretty simple. Our goal is this continues. And this is really a proof on one part of our strategy. This is a proof on the mix. There's still the other 2 pieces of our strategy pillars that can work as well. So from a capital allocation perspective, we target this, and we've targeted this for a while, that 70% of adjusted EBIT becomes free cash flow. We've been a little bit above that target, and hopefully over time our model continues to produce cash. Our main focus with this cash is acquisitions. We're going to be very careful and thoughtful and measured with these acquisitions. The other thing that we've done with our balance sheet is we've kind of reworked our balance sheet over the last 2 or 3 years. We were in a position in 18 and 19 where I think our interest was 13% because we had built this problem, I would call it. Our strategy had not worked. So we've completely, we've rid ourselves of that lender, which helped us through that period of time. And then obviously we've got a new lender, and as our positions become stronger, we're in a better negotiating position. And right now, we've increased our revolver from 25 to 50 million, and we've got really favorable terms. And they understand that they're a lender that's in the E&C space too, and they like the fact that we have cash and we're flexible. So we've been able to, because of our balance sheet, because of our thoughtful allocation, we've been able to improve that. So our big focus, I think, going forward is using cash for acquisitions. So from an acquisition strategy perspective, you can see there's lots of geography to fill in. And just because there's lots of geography doesn't mean we're just going to fill it in to fill it in. We're going to be very thoughtful. And we have 2 different types of acquisitions that we're really focused on. One is a tuck into an existing location. And we recently did a deal in early July with Acme Industrial, and I'll get into that a little bit. But that's an example of tucking into an existing location. The second type is a new geography. $25 to $40 million deal. We can get somewhere where we're not. Sometimes those businesses are going to have to shift from GCR to owner direct. But I think we've realized over time that it's all about, there's a few different things. And I guess this is a segue into, is the owner going to stay? We want the ownership, we want the owner and the leadership staff to stay. We want to make sure they have a niche, and they want to be a niche player, and we want them to have building owner relationships. And that's kind of our criteria. And we're not, I don't view ourselves as a roll-up. We're much more of integrating these acquisitions, and our deals, I think, reflect that. Our goal is in the range of 4 to 4.5 times adjusted EBITDA. Our goal is that it's going to be an earn-out over a period of time, and that we extract value with that owner so that they get their initial cash up front and there's earn-out, and that's a win-win deal. And these are the things that we've learned. So we've learned a lot over the last 7 or 8 years, and I've learned a lot, and we want to apply those to the acquisitions to extract value. And it's really data driving the decisions, common operating system, niche focus, and selling direct to business owners. Not very complicated, but in an industry that everybody's a generalist, everybody chases a new project, these are actually very unique compared to a lot of other people in our space. So you look at Acme, and I'm all about the proofs. I want to make sure our strategy is then matched with a proof. So we did the Acme Industrial, as I mentioned, in July. This is a deal actually found from the Jake Marshall owner. And Jake Marshall was the other deal that I talked about that we did at the end of 2021 in Chattanooga in an industrial company that we purchased. So meets our criteria, has a niche, it's a very particular niche actually in the hydro space. They actually call themselves the EMT of the hydro space, which that alone is perfect for us. That's the type of niche market that we're looking to get ourselves into. Great, it was a primary owner direct business, lots of owners, and it met our criteria. It was a good deal up front, and then the owner understands that we're trying to drive value and we're trying to work together to drive that value. And that's just an example of a deal. And I would stress this, just because we have a balance sheet versus cash doesn't mean we're just going to go frivolously use that cash. We're going to be very measured. We've done 2 deals. Every time we do a deal, we're going to learn from them and we're going to update our strategy. And that's kind of the continuum method, I think, for a decent period of time. So just real quick, some of this is outdated, obviously, from the IR, but we've updated our guidance from 2023 at the end of Q2, and we see we feel like even way past this year, there's a lot of opportunity. So the other thing, too, is I think there's a couple people that I've talked to in this group, but we're very much focused on social media and telling our story through social media. Stories of the company. It's a people business that we're in. We have a very disciplined strategy, but it's very much a people business. And we look at that as obviously driving the company going forward. So again, just to leave you, mix shift, evolved, increased margin through evolved offerings and acquisition, and driving those acquisitions from the core cash of the business. So thanks, everybody.
I think the best place to start on kind of our Q&A is a lot of people, I think, live in a home with an HVAC box right outside of it, and it just looks like a simple box sitting outside the home.
Sure.
That someone comes and maintains, once a year, services it. And I just want you to kind of lay out for people how the types of systems you guys work on differ from that, in terms of that just being a commodity, you install someone else's box and kind of leave it, versus the complex systems you guys work on.
Sure. Now, I'm preference this. I'm sure everybody's home unit is mission critical if it goes down for your family. So I want to preference that, but it is at my house. It's a matter of there's complex systems with duplication, with N+1, N+2, and that's feeding a very critical space. And I kind of use the OR as a perfect example. They have a HVAC unit that has heating and cooling, but there's also a subcool for that unit as well too. There's people that you can't do, the owner can't perform their main business without that unit operating. I mean, I think that is the core. The other thing too is there's a lot of connected pieces of equipment in the buildings that we're in. They need the system to work. So if the main driver of the system goes down, that one device in that one room won't work. And that's really driven us to our 6 vertical markets. And I preference the vertical markets. We're even more disciplined than those 6 vertical markets really indicate, even from a higher ed perspective. We want to be in the life science building where they have grant money, where they have to perform it, and these experiments can't go down. Those are the type of building. If it's a higher ed, just a general admin building, we don't even do that at the higher end. So it's super focused on these mission critical, have to be up, otherwise their business will be just interrupted.
Helpful. And this transition towards ODR, I mean, the company's gross margins have doubled over the last 5 years, from 10-11% to 21-22%. I mean, if you continue shifting the business towards owner work, and within the owner work towards the higher value, kind of more operating expense type work, I mean, how much higher can gross margins go from here? So
we try to use that chart that shows, it's probably a graph that shows where we're at. I very much feel that we're in the bottom left-hand corner of this. Even though we've doubled, to me, that's just gotten back to where we should be. But I really view that if you take a look at those companies that are in the far right-hand corner of that chart, those companies have margins in the 30s. And I understand those are different companies, but from our perspective, we see that as the opportunity. And I think some of it's just simple math. If we get to 100% owner direct model, that's already in the 25 to 28. And that's how we're shifting over a period of time. We take that 25 to 28 and we evolve our offerings with focus based on embedding ourselves in the facilities. You could see over time that we could get ourselves above that 25 to 20 into the 30 range.
And even within the general contractor, I think you've described to me before that there's upside there as you get embedded into these buildings, and the buildings demand that the general contractor uses you guys. I mean, how is progress going on that front in terms of, are there tangible examples of that happening yet?
Sure, and just a little bit of detail for those that aren't familiar with the GCR. So again, it's a two-step model. We work for the GC who works for the owner. It's pre-baked. We're not at the table. And that presents a lot of problems. Cash, not being able to communicate to the owner, provide our value. So One thing that's been a pickup over time is you don't have to have that work, and that work tends to be larger projects, and you kind of just ride the wave of resources. So if you have a set amount of resources, you kind of just have to take what's available to get those resources. We've flipped that model around to the point where we're not dependent on this GCR work, and it's our terms, our price. And I think over time we're going to be in a position where, and we've seen this already, where the owner basically says, Limbach's been in my building for 20 or 30 years. There's a project coming up. You really should talk to Limbach before you build that. And then at that point we say, okay, yes, maybe we'll like to be a part of it, but we're going to pick this scope that's de-risked. Here's our price and here's our margin. And the biggest thing that's helped us, I think, in the last year on our GCR segment is the fact that we don't have to have it. Owner direct's driving the business, generating the cash. The GCR side of it, we can be ultra selective. And whether that, a lot of times the owner can influence the general contractor, but at the end of the day, it's still up to us for first right of refusal whether we want to do that work or not.
Helpful. And in terms of, so if you guys keep getting gross margins up from 20 to high 20s or even 30%, how much of that flows down to EBITDA? I mean, EBITDA margins have gone from 4% to 8%. Can they go from 8 to 15?
You look at it, we've got a little bit of guidance in our deck. You'll see that our SG&A is in the 15.5 to 16.5 range. It's kind of where we're guiding right now. I always tell people this: if I can get 4% on the gross profit and spend 1% on the SG&A, I'm going to do that math. So I think eventually, not every bit of it will fall to the line, but this ultra high quality model, a good chunk of it should. And that's over time. We'll continue to adjust the SG&A guidance, but there's a lot more opportunity on the gross profit than there is. The SG&A side of the business. Maybe we'll get to the point where we can leverage the SG&A and kind of levels out, but we're super focused on the gross profit side.
Now, what would you say to, skeptics who say the economy is really strong? Of course, it's easy to get higher margin work today because no one could find a contractor to do any work. It sounds like you're rejecting building backlog, which is good because you want to get the high margin stuff. But if the economy slows, margins are going to revert, and this is just a cyclical business instead of transforming into a true higher value service partner to these programs.
And it's super tempting right now to just take the backlog. And we have lots of employees. You got to remember, we have 1,500 employees, and they're used to building these big buildings. And they're saying my identity is based upon building these big buildings. And we're asking them to, instead of work on that construction, I need you to go to the building owner. I need you to be there at the facility. Treat it like it's your workplace, but it's totally different mindset. And that's where we're really establishing the relationships. And this is the feedback we get from owners right now. I can't get anybody to be consistent to give me the same team over and over again. They see what's going on. Even in a customer, entertainment customer, they were asking us, are you going to be here all the time? Because my other contractors just leave when there's a larger project. And we're like, no, that's our model. So it's really difficult to be disciplined, but we've learned over time that embed yourself into these facilities, make sure that they understand that they get the same team, and when the space inevitably is going to be cyclical and it comes back down again, they're still going to want the same level of service. We're going to understand the building. It's simple as this. Do we have the keys and the key card codes to get in I was in a customer, and I visit a lot of customers. That's what's really important to me. I got to know what happens. So I probably visited 50 or 60 customers. Just having the keys to the building is just having security. You can't just show up to the facilities that we're at. You have to be embedded. There's background checks. So that's a big part. That's a huge part of it as well too. There's so many different facets that allow ourselves to be embedded while other people are chasing. So the other thing too, not to go on too long, but on this, but we have a pretty big customer list right now. We have 1,500 customers. Our goal, and we've had each one of our locations rate the customers, A, B, and C. C customers, we're trying to move them along. And it's actually more difficult than you think to move along a customer. First thing we do is raise triple the price. So we are raising prices, and a lot of it's on our traditional maintenance base, which is a lot of stuff we do is totally counter to what you'll hear from other companies. But that's another example of we're setting ourselves for the long term, and we're telling our customers, like, listen, we're getting rid of customers to service you. We want to get involved in your building. So there's a bunch of different measures that we're taking to make sure we're resilient. And those that aren't, it's going to be cyclical.
Helpful. So you guys have, I don't know, 30 million of cash, 50 million revolver, generating 30 million-ish a year. How much can you deploy into M&A? I mean, are you gonna be building up cash faster than you can deploy it?
Could be, wouldn't be a bad thing. I would take that. But our goal is to do 1 to 3 a year. And it could be a couple tuck-ins in a new geography. So that's going to take a piece of those. Again, you can do the math. It's going to be 4 to 4.5 times. And it's going to be I like to be a point where we don't use all our cash for acquisitions. So it allows us flexibility, allows us to invest in different things. But, from the acquisition perspective, for us, it's just making sure that since we're not rolling up a bunch of companies, we really have to learn as we go through these companies. The 2 deals that we've done, the next deal, 2 or 3 deals, I wish I had that knowledge 2 years ago when we did that first deal. And, you can't get it until you do it. But at the same time, it's like I'm really excited to deploy that on the next one. And I'm sure it'll keep going. So we never feel like we've made it. We're always in a position that we're learning from these. And we're very measured. And having the cash, a lot of times I worked for the company for 15 years and we didn't have cash. And I was always asking, like, how is this possible? Like, this is, we're building things that should produce cash that we should be able to reinvest. And I was asking questions over and over again. It just never made sense to me. And it probably didn't make sense. But we're a lot better off having the business generating cash than not. So I don't want to give up on that.
Agreed. I think, how many claims does the company still have from the legacy?
There's a couple left. We worked ourselves through 5 or 6 of these claims. And these are claims from
LAX.
Yes, 17, 18, and 19. So what happens is when you build big backlogs and you have a lot of general contractor work and you're not at the table, you have to recover some of that money for things that happened to you. So we're still working through a couple of those, but the key with those that we've settled is we've been patient and we've been extremely persistent. If you just say, I want to cut a deal, then you're not going to get a good deal. But we've been very careful.
What are we talking, 30, 40 million left?
There's about 30 left. And we don't take that's not the full amount on the balance sheet, but that would be additional cash as we resolve these to deploy.
Helpful. Stocks tripled this year, and you just recently bought $100,000 in the open market. I mean, you don't normally see that out of CEOs. I mean, what do you see in the stock? First of all, why'd you wait? But what makes you excited about the stock today? When you were buying it was at 35. It's at 30 today.
Sure. I go back to 2020, and I was this COO at the time, and I bought about $250,000 at that time. And my wife was like, "Really? Are you going to buy this?" And at the end of the day, she's like, "I'm betting on you, and you're betting on yourself." And that's one thing that, as I went from COO to CEO, to me, it was being able to drive the strategy of the company. And if I'm going to tell people I believe in it, then I should be buying it. And that's my mindset. Sometimes we have periods that we can't buy. But over time, I've bought over the last 2 or 3 years, even when I didn't have complete control. To me, that's the best proof to you that I believe in the company. And, I've got a long way to go. I'm only 41. So to me, it's about, building wealth, betting in the company, and my family believing in me that I'm going to drive the company as well too. So,
very, very helpful. I'll just make one more comment on just kind of framing the stock before we open up the Q&A. But it sounds like to me like EBITDA margins have gone from 4 to 8, but they could still go from 8 to 15 over some period of time.
Sure.
We can deploy our free cash flow at 4 times EBITDA and cause earnings to grow even faster than margins double, earnings could more than double with M&A and organic growth. And we're trading at 10 times free cash flow when MCOR and Comfort System trade at 20 times. So it sounds to me like margins could double, multiple could double, plus we can create some value with M&A along the way. So I think we're just getting started, and open it up to broader Q&A.
Hi, former HVAC engineer here. Just wondering, could you talk about the operating leverage of your company? I'm sure you got these engineers and technicians around, right? So there's a certain amount of work that you need to do. You're still at 50-50 mix. So say with higher rates, the construction side slows down. You're 50%, GCL, whatever that. like, can you help me walk through what that scenario looked like? Yeah.
Sure. We are running away from the GCR work, I can tell you that. If I could get rid of it tomorrow, I would. And there's a number of different reasons, and part of it is I have a lot of knowledge based on what's happened. So our goal is to push aggressively past that 50-50. Our goal is obviously at 23 to get to the 50-50, but we're quickly passing that. So just from a people perspective is, with this mix change, one thing that's been very helpful to us is, there's two things I would say. First thing is, the owner direct work takes less labor. The big construction work that has tons of production, so our headcount has gone down some. The second piece of it is, one thing that we've been successful with is shifting all of our GCR workers and craft to owner direct work. And it hasn't been perfect, nothing is perfect, but that's been our big thing. So we haven't had to go get a bunch of people. And I'll tell you, even on the sales front, we've hired some technical salespeople, but for the most part, a lot of these people have been homegrown. And that's what goes back to, I think I said this when I was presenting, it's, internally are probably the biggest critics. It's about understanding what it means to them, understanding what we're doing over and over and over again. I can't tell you how many personal touches I have to make to individual employees, but converting to them over has allowed us to leverage all the talent in the company and to push them into the owner direct segment. So there will be a point where the GCR drops off, and we're moving as quickly as we can away from that.
I mean, is there, if you just stop all the GCR work today, right? Do you have to lay off a bunch of people? You got some stranded costs at the corporate level? What does that look like?
There's still backlog we have to finish.
Okay.
And this is the analogy I use all the time. We can't take the plane down and switch out the engine. We're switching out the engine and parts while the plane's in the air. And I think what's happened too is we've explained the business case to our operators, to our 12 locations. And it's taken 2 years to get to this point, but now they get it. So now I'm not having to tell them, they're making the decision, hey, I'm shifting away from it. I had a call 2 weeks ago, one of our locations is like, I'm shifting to 100% owner direct. I'm like, thank you, because I don't have to tell you that. But that's the type of forward momentum you get when you've told the story over and over again and you've got the proof. And again, it goes beyond financial numbers. It goes into understanding what it means to them. So we're in a position we have to finish backlog. And the other thing that we've done too is we've jacked up the margin. So we have every Friday we have to go through sales pursuits over a certain amount, and every 6 months they're like, oh my God, the parameters have changed. I'm like, yes, they have. We crank up the margin profile, and that's kind of led. It's another way for them to be pushing towards owner direct.
Yeah, when you're willing to walk away from general contractor work, all of a sudden what you are getting is just naturally a more attractive business.
Yep.
Could you go into the culture a little bit? I could imagine that, if I wake up and I'm going to build, it's very manly and testosterone driven. I'm working on a project, I'm building something, now I'm on site, mentally maybe they feel like I'm essentially an outsourced employee for the hospital. What's that, culturally, what's that like?
Yeah, good question, because that's exactly what I'm talking about when it comes to DARE. So the company's been around a long time, and it's built on generations of people, family generation. That's part of the construction industry, but it's part of us still being a smaller public company. It has to be individual meetings, because you have to explain to them. So if you're building a big project and you're in 100 degrees in the summer and 0 degrees in the winter, it's a lot of it's stability for them. They know they're going to go to that job. They got 3 years worth of work. We have to equate that to them individually to, listen, your home is now this healthcare facility. You're working in the air conditioning. You're not outside in the cold and heat. Your identity is to become a part of the building and a critical part of the building. They want to feel like, just like we all do, they want to feel like they're making a difference. And I think it's just changing kind of their hearts and minds from their identity being large projects to, listen, you're making an impact to people. You're repairing that OR unit. There's a family member on the table that depends on you. And that's how you got to infuse yourself right into their hearts and minds.